Hello everyone and welcome to Ticker.com's news channel on YouTube. On this channel, we review stock markets, discuss financial news, market trends, and economic data from Wall Street to Global Street. So let's dive in. We'll begin our review of global economy with key economic releases in the US and Europe. US non-farm payrolls in October increased 150,000 compared to 297,000 in the previous month. The U.S. Bureau of Labor Statistics reported Friday. The jobless rate at 3.9% and the number of unemployed persons at 6.5 million changed little in October. October payrolls increased below the average monthly gain of 258,000 over the last 12 months, but higher than the 75,000 jobs needed to meet the needs of the expanding population, suggesting that labor market is still resilient. The Labor Department on Wednesday reported that employers posted 9.6 million job openings in September, slightly higher than in August, but substantially higher than the pre-pandemic average of 8 million. Treasury yields for the longer-dated maturities edged slightly lower after the Federal Reserve left rates unchanged but left the door open for a rate hike at the next meeting in December. Policymakers are struggling to lower inflation rate to 2% while keeping economic growth intact and navigating tight labor market conditions. Historically, when interest rates rise rapidly, the labor market cools and economic growth slows. But the latest rates tightening cycle has had little impact on the labor market and economic growth. The Federal Reserve has increased rates over the last 18 months from near zero to close to 5.5%, and the U.S. economy has managed to avoid a much forecasted economic slowdown or a recession. Policymakers are still struggling to cool inflation, which has weakened since peaking in June, but prices are still rising faster than the 2% target rate set by the central bank. In other economic news, the Bank of England kept its lending rate at a 15-year high of 5.25% and held rates for the second time in a row. The Monetary Policy Committee, in a 6-3 vote, decided to leave rates unchanged, and the central bank reiterated that rates are likely to remain restricted for a while until inflation drops to the 2% level. Last week, the European Central Bank left its three key lending rates unchanged as widely expected. We now review global financial markets, including key events in bond market, currencies, energy trading, and stock market. The yield on the 10-year U.S. Treasury eased from 5%, the 2000 level, after the Federal Reserve held rates steady. Gold halted a 3-week rally and traded volatile after the U.S. dollar weakened and Treasury yields edged lower. Crude oil declined 6%, fell for the second week in a row, and dropped to the level before the Hamas attack on Israel as worries of oil supply disruption eased. Natural gas prices in Europe fell 6% and fell for the third week in a row after Israel resumed the supply of natural gas to Egypt. Warmer than usual weather in the region and nearly full storage capacity. The euro rebounded to $1.07 to the level last seen in mid-September after the softer job report and reinforced the view that the Federal Reserve could be done with its rate hike for now. The yen struggled and hovered near its 11-month low level, and currency traders worried that the government was more likely to intervene in the weeks ahead after the Bank of Japan left its ultra-loose monetary policy intact, and added that the 1% limit on the 10-year Japanese government bond is a reference point and not a hard limit, suggesting that the central bank is prepared to let the rates rise beyond 1%. The S&P 500 index and the Nasdaq composite rebounded 5% after the interest rates uncertainty eased in the last week. European markets jumped between 2% and 3% after the Bank of England and the U.S. Federal Reserve held rates steady and followed the lead of the European Central Bank. Market indices in Tokyo and Hong Kong rebounded, tracking gains in New York, but caution prevailed in China markets on the worries of an uneven economic rebound and weak consumer spending growth. Chinese markets are set to decline for the third year in a row and extend losses to 40% on the persistent selling by foreign investors. About 700 companies released earnings this week, and Apple, Airbnb, BMW, Caterpillar, DoorDash, Starbucks, and Qualcomm dominated headlines. We now review the companies with positive quarterly results. BMW jumped after the company said production volume increased 4% to 638,524 vehicles in the third quarter, driven by sustained demand in Europe and the United States. Electric vehicle sales across all brands in the quarter surged more than 79% to 93,931 units, accounting for 15.1% of total deliveries. Starbucks, the coffee chain operator, reported better than expected quarterly sales, and global comparable store sales increased by 8% after average ticket sales increased by 4%, and comparable transactions rose by 3%. Airbnb, the vacation rental platform, reported higher than expected third quarter revenue, but forecasted weaker than expected fourth quarter revenue. Qualcomm, the advanced communication chip designer, reported better than expected revenue and earnings in the fiscal fourth quarter and forecasted higher than expected revenue in the current quarter, signaling an early recovery in semiconductor chip industry. DoorDash, the delivery company, reported better than expected quarterly results after total orders jumped 24% to 543 million, and gross order volume also soared 24% to $16.8 billion. Arista Networks soared after the networking gear maker reported better than expected quarterly results and lifted its sales outlook for the current quarter on the back of higher enterprise demand. Apple declined after the maker of popular communication devices reported a decline in revenue for the fourth quarter in a row and forecasted weaker sales in the current quarter. Solar Edge Technology, the solar power processor maker, reported weaker than expected sales in the third quarter and forecasted more weakness in the fourth quarter, following the ending of incentives in California. Peloton Interactive, the advanced fitness bicycle maker, reported a wider than expected loss and forecasted continued sales weakness in the current quarter. Wayfair, the online furniture retailer, reported muted third quarter revenue growth, reflecting a weak demand for home goods and residential furniture. WeWork, the shared workspace developer, plunged 52% after a report noted that the company is looking to file Chapter 11 bankruptcy protection as early as next week. Match Group dropped 17% after the dating service provider forecasted fourth quarter revenue that fell short of market expectations. Paycom Software plunged 35% after the payroll processor forecasted weak fourth quarter revenue. Caterpillar declined after the industrial equipment maker reported better than expected third quarter results, but offered a softer growth outlook in the current quarter. JetBlue Airways plunged 15% after the regional airline reported lower than expected sales and a wider than expected loss in the third quarter. Pfizer eased after the drug maker reported $5.6 billion in write-down charges related to its COVID vaccine and COVID antiviral treatment Paxlovid. Next week, about 1,100 companies are scheduled to release earnings. Investors are looking ahead to review earnings from ArcelorMittal, Berkshire Hathaway, Biogen, Coty, D.R. Horton, eBay, Genpact, Instacart, LegalZoom, New York Times, Ralph Lauren, TripAdvisor, and Uber. That's all we have this week, and we will see you again next week. In the meantime, you can always refer to ticker.com and keep up with the earnings calendar, global financial market news, stock movers, and economic updates on ticker.com and 123jump.com. You can also get the latest financial books on redera.com and keep up with financial industry events on eventsinamerica.com.